Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
All right, let's look at Peakstone Realty Trust, ticker PKST. It closed yesterday's session, that's February 3rd, 2026, at $20.79. It even touched a 52-week high of $20.85 during the day. But the number that really matters, the one that tells you something fundamental just changed, is the volume. We saw this massive volatility spike hitting a peak of, 10.3 million shares traded.
Yeah.
And to put that in perspective for everyone, the average daily volume for this company is usually a very, very sleepy 202,000 shares.
That volume isn't surprising at all. In fact, it's inevitable. It's the sound of an arbitrage window opening and slamming shut all in the same day. The news dropped on February 2nd. Peakstone entered a definitive agreement to be acquired by a private real estate fund managed by Brookfield Asset Management. It's an all-cash deal, $21 per share, flat. That values the whole thing at roughly $1.2 billion.
Exactly. And the market reacted, violently, in the best possible way. The stock surged nearly 33% in a single day. It effectively closed the gap between the pre-announcement price and the offer almost immediately.
I see why you'd call it the best possible way if you were, holding the bag before Monday. A 33% pop is a lifeline. But let's just look at the spread right now. We're trading at $20.79 against a $21 offer. That leaves almost no meat on the bone for new investors. You're looking at pennies. To me, this price action looks more like a relief rally. The market isn't celebrating some massive growth victory here. They're celebrating a rescue mission.
A rescue mission? I think that frames it far too negatively. The central question we need to debate today is whether this $21 exit represents a triumph of a strategic pivot, the move from office to industrial assets, or if, as you're suggesting, it's just a ceiling imposed by a balance sheet that was running out of time.
I'm happy to have that debate, because when I look at the debt metrics, I don't see a triumph. I see a forced hand.
Well, then let me start by laying out why I see this as a strategic masterclass by the CEO, Michael J. Escalante. You really have to look at where this company came from to understand the victory here. Peakstone was a diversified, office-heavy REIT. We all know what happened to the office sector post-2020. It became uninvestable. Valuations collapsed, vacancies just skyrocketed. Over the last few years, Escalante executed a complete portfolio transformation. By December 2025, they had divested their last office holdings. They are now a pure-play industrial outdoor storage vehicle, IOS.
Pure play is a nice way to put it, sure. But let's talk about the cost of that transition.
The cost was necessary for survival, and the proof is in the operations. Look at Q3 2025. They reported releasing spreads of 116% on a cash basis. For those less familiar with REIT metrics, that means when a lease expired and they signed a new tenant, the rent more than doubled. That is explosive growth. The underlying business is booming, and Brookfield, one of the smartest institutional operators in the world, just validated all of it by paying a 34% premium.
Okay, look, I'm not denying the pivot happened. And I'm not denying that industrial outdoor storage is the flavor of the month, but I am absolutely denying that this sale was done from a position of strength. This acquisition, it obscures some truly, truly terrifying financial fragility. You mentioned the releasing spreads, which are great, but let's look at the balance sheet. Peakstone has a debt-to-equity ratio of 134.3%. That is sky high. But the number that really keeps me up at night is the interest coverage ratio. It is sitting at 0.8 times.
It's tight, I admit, but leverage is standard in real estate.
Tight is an understatement. It's underwater. An interest coverage of 0.8 means their operating income wasn't even covering their interest obligations. They were bleeding cash just to service their debt. Essentially, they were paying the mortgage with a credit card. Brookfield isn't just buying a hot iOS portfolio. They are bailing out a company that likely would not have survived this high interest rate environment as a standalone entity. The upside is capped here because the alternative was, it was potentially catastrophic.
I think you're focusing on a snapshot of the debt without looking at the trajectory of the assets. But let's dig into that asset base because that's what Brookfield is really buying. We should probably explain this iOS concept. It's not your typical warehouse REIT.
It's certainly the buzzword of the moment. Everyone wants a piece of iOS.
It's more than a buzzword. It's a structural shift in logistics. Industrial outdoor storage is a specific high-barrier asset class. So Peakstone now owns 60 of these properties. And we're not talking about million-square-foot Amazon fulfillment centers with robots running around. We are talking about low building-to-land ratios. These are paved yards used for storing semi-trucks, shipping containers, construction materials, heavy machinery.
So to put it simply, it's a parking lot for industrial giants?
It is, but the value proposition is unique because of zoning.
Right, because nobody wants a truck yard in their backyard. It's the ultimate NIMBY, not in my backyard asset.
Exactly. Supply is artificially constrained by restrictive zoning, entitlement barriers, and logistics hubs. You can't just build more of this stuff. Municipalities hate approving them. So if you own the existing yards near ports or major highway interchanges, you have a moat. You basically have a monopoly on that specific geography. And the beauty of the model is the triple net lease structure.
Which puts all the burden on the tenant.
Precisely. In a triple net lease, the tenant pays the taxes, the insurance, and the maintenance. It insulates the trust and now Brookfield from inflationary operating costs. And that's why you see those 116% releasing spreads. The demand for this space is just insatiable, and the supply is legally fixed. Brookfield knows they can't build this portfolio from scratch, so they have to buy it.
Okay, I acknowledge the sector is hot. iOS is the gold rush of industrial real estate right now. But we have to look at the valuation relative to its peers. If this was such a gold mine, why is the valuation so disconnected from the giants? Look at Prologis, a $121 billion market cap titan. Look at Stag Industrial. Peakstone traded at a massive discount to them.
Well, if you look at the price-to-earnings ratio, Peakstone was actually commanding a respectable multiple. They were trading at a PE of about 24.8. Compare that to Prologis at 37.6. It's a discount, yes, but for a small-cap player, 24 times earnings is hardly a distressed valuation.
I come at it from a different angle. PE can be manipulated by accounting, especially with REITs, where depreciation just skews the earnings number. I prefer looking at price to sales to see what the market is paying for the actual revenue engine. Peakstone is being bought at a price to sales of 3.35. Prologis trades at 13.7 times sales. STAG is at 8.5 times sales.
You're comparing a small-cap company that just finished transitioning out of office space to the absolute blue-chip titans of the industry. Of course there's going to be a gap. Prologis has a global footprint and decades of history.
A gap. It's a canyon. That tells me the market never fully shed the office REIT stigma that was attached to Peakstone. Brookfield is picking this up at a massive discount to pure-play peers. They are paying 3 times sales for assets that, in a company with a healthy balance sheet, might trade for 8 or 10 times sales. That validates my point. This is a solvency bailout disguised as a strategic exit. They had to sell because the debt leverage at 134% was crushing their valuation multiple. They couldn't unlock the value themselves.
Oris, you could argue that the market was just inefficient and didn't appreciate the transformation until it was too late. The smart money saw this coming, though. We have to talk about the institutional activity leading up to this. There were signals.
You mean the aggressive positioning?
I mean, legitimate institutional research. Look at Straws, Ohio, the state teachers' retirement system of Ohio. In Q3 2025, they didn't just buy a few shares. They increased their stake in Peakstone by 2,305%.
That is, wow. That's an aggressive move for a pension fund.
It's a high-conviction move. They held over 460,000 shares. They saw the value of the iOS portfolio before the public announcement. They understood that the office stigma you mentioned was an opportunity, not a liability. Vanguard also holds 3.5 million shares. These aren't retail traders gambling on Reddit. These are serious institutions doing the math on asset quality.
That's one narrative. But let's look at the other side of the table. Invesco sold off significantly. They dumped 43.2% of their holdings prior to the news. Citadel sold 14%, so it wasn't exactly a unanimous vote of confidence. For every Stirs Ohio loading the boat, there was an Invesco fleeing the ship. It suggests that the smart money was actually quite divided on whether Peakstone could survive on its own.
Fair enough. Institutions disagree. That's what makes a market. But let's look at the ultimate insider, CEO Michael Escalante. There's a lot of talk about alignment of interest, and I think the numbers speak for themselves here. He owns over 703,000 shares, including his RSUs, restricted stock units. At $21 a share, his personal interest in this deal closing is over $14.7 million.
I'm sorry, but I just don't buy that as a pure positive. Let me tell you why. That $14 million is exactly why I'm skeptical. Escalante's total yearly compensation is around $7.2 million, and 87% of that is bonuses and equity.
Which aligns him with shareholders. If the stock goes up, he wins. If it goes down, he loses.
Theoretically, yes, but practically, it incentivizes him to sell the company to trigger the vesting. Those RSUs vest immediately upon a change of control. He gets a massive payday, $14 million plus, by handing the keys to Brookfield right now. If he truly believed in the long-term standalone value of this iOS platform, if he really thought they could grow to be the next Prologis and trade at 13 times sales, he would fight to keep it independent. Instead, he's taking the cash exit. It makes you wonder if he's selling because the price is great or because he knows the debt maturity wall is coming and he wants to cash out his chips before the house folds.
I think that's overly cynical. Escalante navigated the death of the office sector, a historic collapse that wiped out billions in capital elsewhere, and managed to deliver a cash exit at a 52-week high. He protected shareholder value when other office REITs went to zero. And frankly, a $14 million payout is a standard reward for a CEO who successfully executes a billion-dollar pivot in a hostile interest rate environment.
We can debate the ethics of executive comp all day, but let's bring this down to the listener. Let's say we have a listener with $5,000 right now. They see the news, they see the stock at $20.80. Is there a trade here?
I think there is, specifically for a certain kind of conservative investor. This is a classic merger arbitrage play.
Let's run the math, because I just don't think it holds up for the average person. So $5,000 at the current price of roughly $20.80 buys you about 240 shares, correct? Okay, scenario A, the deal closes as planned. You get $21 cash per share. Your profit is roughly $40. That is a 0.8% return. Is it worth tying up $5,000 for, 3 to 5 months for $40? I mean, that's barely lunch money. You could get a better yield in a high-yield savings account right now.
You're framing it as tying up capital, but I view it as parting cash. In a volatile market where tech stocks can drop 10% in a day, a near-guaranteed 0.8% return is attractive. And regarding the time frame, if the deal closes in, say, 2 months, that annualizes to a return of roughly 5%. Plus, you have to consider the tax benefits.
What tax benefits? You're getting cash. That's a taxable event.
Not necessarily the whole picture. The news on January 29th confirmed that the 2025 distributions are classified as return of capital.
Ah, the ROC classification.
Exactly. For taxable shareholders, a return of capital distribution doesn't get taxed as ordinary income immediately. Instead, it just reduces your cost basis. You defer the tax liability until you actually sell the stock. So for a sophisticated investor, parking $5,000 in a defensive, tax-efficient merger arb play is smarter than leaving it in a checking account. It's about portfolio efficiency.
Okay, that's a very specific use case for someone trying to optimize their tax drag. But let's look at the other scenarios. Scenario B, a superior bid comes in. The go-shop period ends March 4th, 2026. If someone comes in with, say, $22, that profit jumps from $40 to $280.
Which is a nice little option to have for free.
But scenario C is the killer. Deal failure. If the financing falls through or regulators block it, however unlikely, where does the stock go? It goes right back to the pre-announcement range, $14.50, maybe $15.50. You lose $1,270 instantly. You are risking over $1,200 to make $40. That risk-reward ratio is just horrific. It's picking up pennies in front of a steamroller.
I disagree on the probability weighting of that. The risk of the deal falling through is minimal. Brookfield has deep pockets. They aren't relying on shaky financing markets. And the spread, trading at $20.79 versus $21, that tells you the market sees this as a done deal.
The market is pricing in a 99% chance of success.
But there are still risks. Look at the litigation. You have firms like Helper Sade and Ademi LLP already investigating the fairness of the price.
Oh, come on, that is standard ambulance chasing for mergers. Every public company buyout gets sued. It's just noise. They file a suit, they settle for a disclosure amendment, and the lawyers get a fee. It very rarely stops a deal.
It might be noise, but it highlights the termination fee. There's a $16 million termination fee. That makes it very expensive for a rival bidder to step in. They have to pay Brookfield $16 million just to get to the table. An analyst at UBS already viewed $21 as full pricing.
I agree with you there. A bidding war is unlikely. But that actually supports my point that the floor is solid. Brookfield paid a full price because the assets are quality. They didn't lowball it.
Full price for a distressed balance sheet? Maybe. But let's go back to the Go Shop. The company has until March 4th to actively solicit other offers. Do you genuinely believe another bidder's going to emerge?
It's possible, but unlikely, given the termination fee and the debt load you're so worried about. But the existence of the Go Shop provision proves that the board and Escalante were trying to maximize value. They didn't just sign the first deal that came along. They built in a window to check the market. It shows good governance.
A window that costs $16 million to open. It feels performative to me. It just lets the board say we tried while they lock in the Brookfield deal.
It's standard governance. But let's zoom out. If you are holding Peakstone right now or considering that $5,000 buy, you aren't betting on a bidding war. You are betting on certainty. You're betting that Brookfield $1.2 billion check clears.
And that brings me to my closing thought. Peakstone, to me, is a don't touch for any growth investor. If you want exposure to industrial outdoor storage, which I agree is a fascinating sector, don't buy Peakstone for a $40 arbitrage profit. Take your $5,000 and look at Terreno or STG Industrial. Buy the companies that are staying public, that have healthy balance sheets, and can actually grow. Peakstone is a capped trade. The upside is 20 cents per share. The risk, however small, is 25% downside. That math just doesn't work for me.
That's a fair perspective for a growth investor looking for a 10x return. But I see this differently. This is the story of a successful transformation. Michael Escalante took a company that could have been crushed by the office real estate apocalypse and steered it into the safest harbor in the industry, industrial storage. He delivered a cash exit at a 52-week high. For conservative investors, this is a low-risk place to wait out market volatility. It's not about getting rich overnight. It's about capital preservation with a slight upside.
We can agree that the pivot was the right move. I mean, if they had stayed in office buildings, we'd be discussing a bankruptcy, not a buyout.
Exactly. The industrial outdoor storage strategy was vindicated by the $1.2 billion check Brookfield just wrote. The stock ticker might be disappearing, but the thesis was correct.
The strategy survived, even if the company didn't.
And sometimes, in this market, survival is the ultimate success. That wraps up our analysis of the Peakstone Brookfield deal. We'll be watching to see if a superior bidder emerges by March 4th.
Don't hold your breath.
Until next time.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.